Hi everyone, welcome to our latest Artemis Live video. This video we've decided to bring you something short and quick to discuss the happenings at the US Capitol building yesterday. I'm sure pretty much everybody is aware by now that the US Capitol saw a relatively unprecedented amount of civil commotion and disturbance yesterday, resulting in people actually gaining access to the Capitol building and some damage being caused, and sadly some deaths as well, according to the latest press reports. During the course of this year, our good friends and supporters, Tom Johansmeyer from PCS, has been discussing strike, riot, and civil commotion at a number of our events and some of his own webinars, etc. So I thought it'd be interesting to talk to Tom and just get a bit of an overview as to exactly what yesterday's happenings at the Capitol could mean for the insurance and reinsurance industry. So, Tom, good to see you. Thank you for joining me.
Likewise, Steve. Thanks for having me. I appreciate it.
Sure. So, yeah, as I said, unprecedented maybe. Certainly something that hasn't been seen for a couple of hundred years. I mean, talk us through what you've been seeing over the last year. I know sort of SRCC has been a hot topic for you, and what do you sort of think has led up to this point as well? And give us a bit of background on it all.
Yeah, so from about 12 months ago, the PCS team's been focused closely on SRCC. Originally, into Q1 last year, it was driven by the Chilean riots of 2019, which, though concluded as a catastrophe event, still showed like cultural and social signs that there could be a resurgence of civil unrest due to underlying conditions that caused the riot first time around. Now, keep in mind that riot was the largest we have on record with PCS in terms of insured loss, north of 2.5 billion US dollars. So the Chilean riots were very, very significant. We started out 2020 thinking that Latin America could see continued civil unrest. Because, of course, in addition to Chile, you had Venezuela and Colombia and other, I think Ecuador as well, in the region where there were significant economic losses but not insured. From the onset of COVID-19, and I'm thinking probably mid to late March, the team spent a lot of time discussing SRCC again. The drivers being pretty simple. If you've got massive amounts of anxiety, social concern, you've got people getting sick or worried about getting sick, you've got people losing their jobs, economic strain, you're not sure how you're going to pay your rent, you're not sure how you're going to put food on the table. These are the sorts of things that people respond to viscerally, right? And there are the sorts of conditions that increase the risk of civil disorder. And then, of course, there were the riots in late May, early June, which became the first multi-state catastrophe for riot and civil disorder in PCS history. In fact, not just more than one, but more than 20 states were included in that $2+ billion industry loss event. And then throughout the year afterward, Chicago's Magnificent Mile, Portland, Philly, there were other isolated incidents of riot and civil disorder, which, though culturally significant, didn't generate significant insured loss to become a catastrophe event. So that's the context we had from the year going into last night.
Yeah, no, that's really interesting. Thank you, Tom. Very helpful to understand sort of the scale of some of the activity that you've seen earlier this year as well. I mean, with that sort of 2 billion loss event that you mentioned, how does that flow through the insurance and reinsurance market? And does it have ramifications for retrocession when it gets to that level?
I haven't heard much about retro ramifications. So, UNL retro in particular can vary widely. As far as the ILW market, we haven't heard anything getting threatened or even triggered. And mind you, where the riots would become significant on that basis would be in the ILW market as contribution to an aggregate, if if man-made or non-nat cat is included, and we're below the $2.5 billion mark with the U.S. riot, so it's hard to say where the franchise deductibles would be, but anything under 3 is pretty light, especially since 2017. So we're not sure. We really don't think there's much of an ILW impact there. We haven't heard of any at all. The traditional UNL, not so sure. As far as insurance to reinsurance, it's more interesting because a handful of large commercial insureds accounted for almost a third of the industry loss from the U.S. riots, which is consistent with what we saw in Chile. So in Chile, we had nearly $1 billion US from a handful of retailers. Retail sector, again, contributed heavily to the U.S. riots last year. So there are kind of CAT issues and individual risk issues coming out of that. We're still seeing development there as well. So obviously, significant insured loss, presumably some flow through to reinsurance as well. But how that happens could vary based on the the large risk factor involved as well.
Sure. Great. Okay, that's really good color around sort of what SRCC means and how that's been becoming increasingly prevalent through the last year. So let's fast forward to last night and what were pretty disgraceful scenes for everybody who watched it. And obviously highly publicized on social media and across media channels as well. It's almost as if you can watch these events unfolding in real time. But what, if anything, does that mean for the industry, yesterday's events at the Capitol?
So I huddled with PCS team last night, Ted Gregory in particular, our ops director, who is very, very well connected on the ground for U.S. catastrophes of all types, right? He and I spent a couple hours last night working on this. And what we found is that the threat to the is actually quite small because these are mostly government buildings involved. Insurers aren't picking up the loss for that. Even when there was the spread of this sort of activity to state capitol buildings across the country as well. Again, these were isolated incidents for the most part around government buildings. There wasn't much report of commercial impact, which means that there's a reduced impact of insurance industry loss, right? So again, there are three types of costs that effectively we saw potentially threatened last night. Insurance, economic, and social. The social cost to last night is presumably significant. The economic cost remains to be seen. Obviously, there are two types of economic costs, right? There's direct and then indirect. And if you're looking at increased expense related to government people or equipment or buildings, that ultimately generates an economic impact to the taxpayer as well. Then there's the insurance cost, and that seemed to be minimal at most last night. The real question for the insurance industry isn't so much about the activity around the U.S. Capitol building or the state Capitol buildings. Rather, it's regards the nature of the continuing kind of heightened SRCC risk environment in the United States and what that could mean going forward. So something to keep in mind about SRCC that we've seen over the past, say, 9 months, even 12 months, and that we've seen in our historical data as well, is that it doesn't happen often of a scale and of a nature that results in a significant insurance industry impact. We've only got, slightly more than 10, 12 historical catastrophe events from riot and civil disorder over 70 years in PCS. Only two of them were very large. LA riots in 92 and then the riots last year. So it takes a lot for a riot to reach that PCS threshold, which currently sits at $25 million US, let alone to significantly exceed it. And I guess the best way to look at SRCC risk is to think about lighting a fire when it's windy outside. You can have all your fuel ready, right? Your tinder, kindling, your big logs all packed in and ready to go. You can have a book of matches. So now you've got all the ingredients for fire, right? You've got starter fuel, you've got longer term fuel, you've got the spark, the match, you've got means to make a flame. But if the wind's blowing 30, 40 miles an hour, good luck making a fire, right? It's a very difficult condition to convert those contributing factors into the end state. Riot is similar to that, right? You can have all the ingredients. You can have people, you can have social unrest, you can have dissatisfaction, economic strain, large crowds in one place with a cause behind them. You can have differing factions coming together in that sort of environment of unrest. But for that to then turn into conflict, physical conflict, physical damage to insured structures, and then physical damage with scale, that's a long progression. And there are a lot of opportunities for de escalation of those heightened tensions along the way. And we saw last year, for example, that that sort of de escalation of risk is more likely than the increase of risk to the point where it could become a catastrophe for the insurance industry.
Yeah.
Chicago and Portland are great examples of that.
No, that's a really good point. That these things often don't ever get to the stage where they're really an enormous threat to the insurance and reinsurance industry. And as you said earlier, the social impacts are perhaps always the highest from these things. I guess the question moving forwards is how that social impact is de-escalated as well, and whether the society itself can de-escalate this situation, and we can hope to see the rest of 2021 without any significant rioting at all. What should the insurance and reinsurance industry be thinking about going through the rest of this year? Do you feel is there going to be a heightened risk of SRCC right the way through this year?
It's hard to say what happens after the end of the month. So, if you think in terms of milestones from the US presidential election back in November through the inauguration set to happen in 2 weeks, we've passed through several factors, right? Such as, the counting of the votes and the state certification, the Georgia runoff, the electoral college activity that was occurring yesterday at the Capitol building, wrapped this morning. And then, of course, the steps leading up to the inauguration, which then leads to the new president. I would probably suggest monitoring for some lingering risk after that, because it's not like on a certain day you have a new president sworn in and then, a cultural concern or cultural anxiety for a segment of the population dissipates. That doesn't work. You've got to figure that there's a certain amount of time that would hopefully facilitate a certain amount of de-escalation of SRCC risk. I would certainly say that in the near term, it's worth monitoring SRCC risk. From what we understand through our network in the US, for example, insurers have been reviewing and preparing for this sort of risk, and we've been working with them to understand, any issues that would involve reporting to PCS in the event of another SRCC-related catastrophe. After, I guess, the immediate checkpoints of the inauguration, vigilance is going to be important. Understanding the risk is going to be important. Hopefully, it'll de-escalate. Is there a chance that it won't disappear completely? I mean, of course, there are issues, social, economic, political issues that remain. And these are the sorts of things that could result in the manifestation of SRCC risk. So insurers have to be prepared for that.
Great. Thank you very much, Tom. That was a really helpful few minutes with you. Really good color on what happened last night and what this really means for the insurance and reinsurance industry. And we just have to hope that the democratic process takes hold, gets us through this period, and then the world can continue to deal with the other pressures that it faces right now. So thank you for your time.
Thanks, Steve. I appreciate it.